This is a video on a market structure known as oligopolies that dictates how many different industries work, and in this case we will be looking at the UK supermarket industry and how an oligopoly affects the running of these companies. There are many different market structures and they all dictate in different ways how industries should run. Alternative market structures include perfect competition, monopolies, monopolistic competition, and oligopolies. The main focus of this video will be oligopolies. All of these market structures have different characteristics that affect how certain industries work. The supermarket, for example, is a great example of oligopolies existing in an effective manner. We will discuss the advantages of an oligopoly in this industry as well as the disadvantages and the impacts this has on the greater economy. So what is an oligopoly? An oligopoly is a market structure that is dominated by 3 to 7 firms, although it can have other smaller firms. While oligopoly markets include many firms, the market is dominated by the firms with the highest market share. Oligopoly markets are also highly concentrated, and firms within an oligopolistic structure can become interdependent, meaning their actions are directly affected by the other firms within the market. An oligopoly is unique in the sense that some of the characteristics of an oligopoly are not replicated within other market structures. These characteristics can include restricted entrance for new firms into the market due to high barriers to entry. They're dominated by a few firms. Firms in the market structure are price makers as they have the power to influence prices within the sector. Oligopolies can also lead to interdependence within firms, and also goods are not homogeneous, meaning that there is an element of product differentiation between the firms. So let's take a look at an overview of the UK supermarket industry. Tesco is the largest supermarket chain in the UK and boasts a significant customer base and broad market reach. Sainsbury's has been a staple in the UK retail scene for decades and remains a major power player in the supermarket with a 15% market share in the industry. Asda, which is owned by the American company Walmart, continues to command a substantial portion of the UK supermarket industry with a 14% market share. Morrisons, while a bit smaller than the other firms mentioned, boasts 9% of the market share and rounds out the big 4 firms that dominate this industry. As seen previously, Tesco holds the biggest percentage of the UK supermarket industry's market share at 27%. If we look at this data, which has been taken from Orbis, we can look at the financial report and see that Tesco has suffered from their operating revenue fluctuating in a mainly downward trend. Despite holding the biggest market share, the company has still experienced overall losses. However, overall shareholder funds and total assets have increased, showing that the company is still experiencing growth. The current ratio, which is a measure of liquidity and profitability margins, which is profit margin and a return on equity, show that the company's operational efficiency is unpredictable, meaning that profitability is also likely unpredictable. In a comparison to Tesco, we can look at the third biggest firm in this market, which is Asda. By looking at the data, which is also from Orbis, we can see that their operating revenue has seen a fluctuation as it has been going up in the period between 2018 and 2021. However, it has gone down in 2022. As seen previously, Asda has faced a complete downwards trend in their operating revenue. However, their cash flow maintains an upwards trend. However, the current ratio is similar to that of Tesco and mimics the fluctuating operational efficiency and therefore unpredictable profitability. One characteristic of an oligopoly is interdependence, as I mentioned before. Interdependence means that the behavior and decisions of one firm have direct impact on the decisions of other firms. With Tesco dominating the supermarket industry, it is likely that the other firms within this industry will follow the price trends that Tesco sets in place, which ties back to the characteristic of oligopolies, which is price making. This means, for example, if Tesco increases the price of certain goods, other supermarkets are likely to follow suit. Due to this, firms within an oligopoly follow a kinked demand curve. In the kinked demand curve below, we can see that price and output is set as P1 and Q1. If one firm reduces the price, then they will take demand directly from their competitors. Therefore, the other firms will also decrease price to protect market share. As seen in the graph here, beyond quantity 1, price 1, price elastic demand is inelastic as all firms will reduce price and so market share will remain the same. We assume firms to profit maximize. Marginal revenue equals marginal costs is where firms will achieve maximum profits. The average revenue curve also shows the demand faced by these firms. Beyond Q1, marginal revenue is negative as increasing output quantity will lead to reductions in total revenue. As firms will not reduce or increase price, it is therefore the case that the price and output that maximizes profit must be at the kink in the demand curve, which can be seen at P1 and Q1. Now let's take a look at the advantages, disadvantages, and impacts that an oligopoly has. Some of the advantages include that dominant firms will have increased profits, and this can result in more investment into innovation and investing in new technology as well as research and development. Another advantage is that firms can benefit from economies of scale, which can reduce their production costs, and these cheaper costs can be passed down onto consumers. Oligopolies can also lead to a more productive economy as they can somewhat impact the country's employment rates. However, there are also disadvantages in oligopolies. Firms can collude and form cartels, which result in higher prices for consumers and mean lower income households cannot afford necessary goods. Another disadvantage is the high barriers to entry, which will prevent new firms from entering the industry. Additionally, the lack of competition between firms may lead to inefficiencies within the operation and management of the firms. The impacts an oligopoly has can be separated into these three categories: consumers, firms, and the national economy. Impacts on consumers can include that consumers can face high prices for goods such as food and toiletries, which would directly impact social welfare in a negative manner. Consumers may also have limited choice in goods as there is little incentive for firms to product differentiate. Firms will also face impacts from an oligopoly. New firms will find it difficult to enter the industry due to high barriers to entry, and existing firms which are not dominant in this market structure will be unable to experience growth and may be forced out of the market. And the final impact is that the economy can also be impacted by oligopolies. Firms such as Tesco, Sainsbury's, and Asda have significant impact on national employment rates as they boast large workforces. If a company decides to have mass layoffs, the national economy will suffer greatly. So, in overall summary, the UK supermarket industry is an oligopoly with some element of competition between the dominant firms. Oligopolies can lead to inefficiencies within an industry and therefore should be better regulated to prevent collusion and to ensure opportunity for new enterprise. And while imperfect, oligopolies reflect a more realistic market structure than others, such as perfect competition, which cannot exist in a practical setting.